In the early 1990s, the world watched in awe as a new economic miracle was born. Across East and Southeast Asia, economies were growing at a breathtaking pace, transforming from agrarian societies to industrial powerhouses in a single generation. They were known as the Malaysian Tigers, and it seemed their rise was unstoppable. But beneath the surface of this rapid ascent, a house of cards was being built, one with a foundation of risky loans, political cronyism, and a belief that the boom would last forever. It was a delusion that would bring down entire nations, one by one. Welcome to Economic Epochs. Today, we're journeying back to 1997 to explore the story of the Asian financial crisis, a spectacular collapse that proved just how interconnected and fragile the global economy had become. We'll discover how a small currency devaluation in Thailand sparked a regional firestorm that threatened to engulf the world. The story begins with a period of remarkable success. Countries like Thailand, Indonesia, Malaysia, and South Korea were experiencing unprecedented economic growth, often reaching double-digit GDP figures. Foreign capital poured in, eager to get a piece of this new prosperity. Western banks and investors saw a fertile ground for investment, and local governments were happy to oblige, often maintaining fixed exchange rates that made their currencies seem stable and attractive. This created a powerful illusion of security and invincibility. On the ground, this money fueled a boom in real estate, infrastructure, and ambitious industrial projects. Skyscrapers shot up in Bangkok and Kuala Lumpur, and factories hummed with activity. But much of this growth was built on a dangerous foundation of borrowed money. Corporations and banks took out massive loans, many of them short-term and denominated in foreign currencies like the US dollar. They did this because interest rates in the US were lower, and the fixed exchange rate meant they believed there was no risk of their local currency devaluing. The first crack in this facade appeared in Thailand. The country's economic growth had been driven by a property bubble and massive foreign debt. By early 1997, it was clear that many of these projects were not profitable, and foreign investors began to grow nervous. Speculators, most famously the hedge fund manager George Soros, noticed this fundamental weakness. They saw that the Thai baht's fixed exchange rate was artificially high and would inevitably have to fall. Soros and other speculators began to short the Thai baht, betting that its value would drop. They borrowed large sums of baht and immediately sold them, creating a massive downward pressure on the currency. The Thai central bank, trying to defend its fixed exchange rate, spent billions of its foreign reserves to buy back the baht. But the effort was futile. By July 1997, Thailand ran out of reserves and was forced to devalue the baht, letting its value float freely. The currency immediately lost a huge portion of its value. The moment the Thai baht fell, the dominoes began to topple. Investors, spooked by the sudden devaluation, began to withdraw their money from other countries in the region, fearing the same thing would happen. This contagion was not a slow-moving virus, it was a flash flood of capital fleeing East and Southeast Asia. Malaysia. The ringgit came under attack, and the government, led by Prime Minister Mahathir Mohamad, blamed foreign speculators like Soros, calling them immoral and unnecessary. Despite their resistance, Malaysia eventually had to let its currency fall. Indonesia. The rupiah plunged in value, and the country was plunged into a social and political crisis. Riots and civil unrest erupted as the cost of living skyrocketed, eventually leading to the downfall of President Suharto's 30-year regime. South Korea. The crisis spread to South Korea, where its massive, family-owned industrial conglomerates, known as chaebols, had accumulated huge debts. The won plummeted, and South Korea was forced to go to the International Monetary Fund, IMF, for a massive bailout. The crisis was a textbook example of systemic risk. The interconnectedness of the region meant that a small problem in one country could quickly become a catastrophe for all. The crisis was brutal. Stock markets across the region plummeted, businesses went bankrupt, and millions of people lost their jobs. The IMF stepped in with massive bailouts, but the conditions it imposed, demanding austerity and painful reforms, were deeply controversial and led to widespread resentment. The Asian financial crisis was a profound wake-up call. It exposed the dangers of crony capitalism, the fragility of fixed exchange rates, and the immense power of global capital flows and financial speculators. It forced Asian economies to re-evaluate their financial systems, strengthen regulations, and build up their foreign currency reserves. The event also highlighted a key theme we've explored before, the nature of speculative bubbles. Like the South Sea Company and the Roaring Twenties, a period of euphoria and rapid growth masked deep structural problems. And when that confidence was finally shaken, the crash was swift and devastating. The Asian financial crisis was a painful chapter in economic history, but it taught us invaluable lessons. It stands as a timeless reminder that in an interconnected world, no economy is an island. And no amount of prosperity can inoculate a nation against the fundamental forces of speculation and the power of human emotion.